Hello and welcome to The Hash. I'm Zach Seward. Today we got George Kaludis, we got Will Foxley, we got Christy Harkin. We're The Hash. We're here to have some fun, get you up to speed on crypto news. We're going to start with mining here in the A block, and we're going to start with Will Foxley. He knows about mining, and he's going to talk to us about some stuff out of the EU. What do you got?
We're talking about proof of work, Zach, not just mining. This is all for all the proof of work coins that are out there that are currently under attack from regulators around the globe. So Eric Theoden is the VP, as I understand it, of the European Securities and Markets Authority, or the vice chair rather. And he says that proof of work should be banned in favor of proof of stake. The reason being is that proof of work is too energy intensive. Now, this is a conversation that's been happening ad nauseum for the last year plus. Notably, Elon Musk had that tweet back in April that kind of tanked the crypto market by like a nice 50%. And he said, hey, we're not going to be accepting Bitcoin because it's too energy intensive, or at least until it transfers to more renewable energy sources. Doesn't mean that conversation has ever gone away. It doesn't mean we're still in the middle of it, right? And now we're seeing that governing bodies from these regulators are cracking down on it even more, and they want to get rid of proof of work in favor of proof of stake. I can go on and talk about why one is better than the other or vice versa, but I want to throw it up to George and get your take on this. I don't know. Any new thoughts on this? Because we've definitely covered this topic a lot on the Hash so far, but every day it seems to be like a new governing body is taking the side of proof of stake.
Yeah, this is really convenient timing as well. There's a Congress hearing on this soon. I think actually tomorrow. Politicians are slick, man. They think they're slick, at least, I swear. I also think it's a really weird comment. He's talking about banning proof of work mining in the EU. And where exactly are the big mining operations in the EU, right? We have data from Cambridge that suggests a small percentage of Bitcoin's hash rate comes from Ireland and Germany, but Cambridge themselves put an asterisk on that data and said something like, there's little evidence of large mining operations in these countries that would justify these figures. And it's likely due to, redirected IPs with VPNs or some sort of proxy service. Not to sound like too much of a conspiracy theorist, but I think it's largely performative. There's no substance to this, right? This regulator has an idea about proof of work, says he doesn't like it, uses platform to say we should ban in the EU, has no teeth. Zach, throw it down.
I want to ask you a question of Christy, because I think it's interesting to kind of peel it back. I want to understand, as a design choice, now here in 2022, it seems like proof of work, proof of stake, two competing technologies that you can choose from. But when Bitcoin launched, proof of work was a necessary design choice. And I just wanted you to sort of unpack why proof of work is what it is and what proof of work does that proof of stake hadn't yet been capable of doing when there was no network around which these coins could be circulated. So why proof of work? Let's just peel it back a second and converse. I'm throwing it to you, Christy.
So proof of work mining is a way of securing the blockchain, and it's an important way of securing the blockchain for a proof of work blockchain. The idea is that you have to expend some energy, you have to invest something in the process of mining and prove that you did that in order to participate. And it's to prevent spam, it's to prevent interference, it's to prevent hacking and all kinds of nastiness that we don't want to happen to break the blockchain. And this was a massive innovation for security and for cryptography when it happened. And then proof of stake came along later, and it became a way of participating in a blockchain without having to expend the energy. It's saying you can sort of buy a stake. You can buy some security proof on a blockchain. And there are people who think it's fantastic. There are others who don't think it is as secure, who think it's riskier. And then there are questions of decentralization that, may or may not bear out in terms of, will it be taken over? Can a blockchain more easily be taken over by a centralized power who buys more and more stake in it? I guess you could say the same thing with proof of work if you buy more and more miners, but I think it's something that will still have to play out in terms of the pros and cons. But I think it's interesting that we have three of us, and Zach, I'm not discounting you, but three of us who are all about proof of work on this topic.
Get wrecked, Zach. Get wrecked.
Yeah.
I'm proof of stake, man. Energy efficient.
Well, no, I'm going to defend myself a little bit. I do think that proof of stake is interesting, but I think it's just very different than proof of work. And that's something that these comments from all these politicians just gloss over. They think that the two are synonymous, and they think that you can just kind of use this for one for the other when they have very different applications. Proof of work enables you to verify the chain from the beginning, from 2009 all the way till present day. You can verify that same amount of Bitcoin have been there, that your old transactions are there, that other people's old transactions are there. Proof of stake has some design choices that means that necessarily you can't always trust that chain from its genesis block, which means, and often Bitcoin core developers argue this, you can't really use it for money because you can't really audit it all the way back. But I think it is just notable, and the takeaway for me from this article and from this instance of this EU regulator talking is, again, we see people think that they're the same thing and they're synonymous, and you can just kind of plug and play with different consensus mechanisms. But that's enough nerd speak. I think we got a different topic coming up from Zach here.
Let's do some more nerd stuff. We're going to stay in the world of mining, sticking with Argo blockchain, which is a London-based, publicly traded mining firm. They rolled out this thing this morning saying that they're going to be dabbling in some other stuff besides mining proof-of-work coins, such as Bitcoin and Zcash. They're rolling out this team called the Argo Labs. There's a brief mention of NFTs, Web3, DeFi. What it's going to look like is a bit unclear, but I thought it was interesting to see a Bitcoin mining firm diversify into some other aspects, some other arenas of the crypto space. And I'm curious to know if this is an indicator of other things to come. You know, these firms tend to have large crypto reserves or large Bitcoin reserves in this instance, and maybe they want to figure out some other ways to diversify making money besides doing the Bitcoin mining. I guess I'm going to toss this to Will because he has a bit of an inside perspective as editorial director at Compass Mining. Not going to put y'all on the spot, but just curious to know, like, is this diversification within the mining industry an aberration, or is this potentially a trend that we'll be seeing emerging here in 2022?
Totally. So Argo does have a lot of different fingers and different pies, not just mining. We had Peter on our Compass podcast, I think 2 or 3 months ago, kind of talking about what Argo's up to. And they definitely do more than just Bitcoin mining and Zcash mining. They have some investment funds and different coins. And here we see that they're kind of moving into the labs space, which is very common for people with a lot of money, go hire a bunch of developers, put them in a WeWork and say, build something cool for me. And often you see cool things come out of it, like Ethereum or different projects like that. And it's often also very monetarily incentivized, right? You get a lot of stuff out of it, which is good for your ROI on your baseline. And when you look at Bitcoin mining, it tracks Bitcoin's price. And as a Bitcoin miner and as a public firm like Argo, that can be a little dangerous, right? So in the past, Bitcoin has dropped from very highs to very lows quickly, and it's left a lot of people with bumps and bruises along the way. Bitcoin miners, especially these public ones, are more and more looking to kind of offset that risk by investing in different assets and in different classes of crypto and kind of hedge that downturn. So it's not very surprising to me to see Argo move even more in this direction. They're definitely like on the cutting edge of Bitcoin miners in terms of appreciation of different crypto assets, but it's definitely not surprising to me. I do have a question for George, though. What's your kind of takeaway on this? My understanding is that you're kind of more of a Bitcoin, not blockchain guy, and you want to kind of keep that purity within Bitcoin itself, but you often don't see miners do that because it's not profitable to only say Bitcoin all the time.
Yeah, and although I do say I'm a Bitcoin maximalist, I understand that there are profit incentives. There are ways to make money outside of Bitcoin that aren't just out and out scams. So I'm not going to say everything's a scam that's not Bitcoin, which is unique, I guess, amongst this crowd. But I think the thing that came to my head when reading this is actually tied into the last conversation we just had about moving from proof of work to proof of stake and the trade-offs you make there. Perhaps, I mean, Argo's been mining Bitcoin since 2017 and proof of work coins since 2017, I think is right number or right date. Do they see a potential where a lot of proof of work coins fall off? We don't have enough computational power for 5 proof of work coins, and we have 1 proof of work coin with Bitcoin, the king of all money, right? And then we have a bunch of proof of stake coins that they can play in, right? They have a pretty inflated treasury, I'm sure, and they know plenty of people in the space. They know all the developers. I'm sure they can find a place to put money to work when you can only get so many miners. You can only get so much space, and it might be them trying to position themselves to take advantage of proof of stake stuff coming online.
And it's free market, man. I mean, it's what they're going to do. And I mean, we've seen a lot of companies move that aren't Bitcoin companies or even blockchain companies who in the last year and a half or so have decided they want to get into the space. So it's not surprising that those companies within the space are also going to look into diversifying what it is that they do. That was my takeaway from it.
Just to kind of wrap that conversation up really quick, I agree with both what you guys are saying. Like, it just makes sense. If there's money on the table, people are not going to take it. And that becomes even more true once you go public and you have these things called shareholders who don't care what coins you're holding. They don't care at all. They just want to see that at the end of the day, their 401k rise. Yep. It's just how it is. So, but it is interesting to get both of you guys' perspective on that. But I'll give it to Zach because we have something called the break coming up, I hear.
That was nice, Will. Thanks. We do have the break coming up. We're going to take a break, pause, grab a sip of water, sing a little song, watch a little promo. It's good stuff. After the break, though,
it's good song.
NFT turf wars, Ethereum versus Solana, big banks shilling Solana and NFTs. It's going to be great. Stick with us. It's The Hash. Hope you're having a good day.
What's up, everybody? This is Spencer Dinwiddie.
And I'm Solo Cisse.
And this is New Money, brought to you by CoinDesk.
All I hear, go get the money. So I go get it. Hate means I do something right. So I'ma let him. Yeah, I'ma let him. Yeah, I'ma let him. I hit the nail on the head. Yeah, I'ma let him.
What we'll see is money not only being exchanged for this digital currency, but the frictionless movement across borders. It's gonna be able to flow as easy as a text message.
Staying true to yourself, right? Like, you've always been true to yourself.
I just want to share that with everybody. You know, you could be yourself in full capacity.
It's our duty to take our visions and be fearless in our pursuit.
Be my most authentic self and show people that, look, I'm an athlete, and yes, I'm also a part of the LGBT community.
My goal is to have, my own NFT, my own entire IP, like my own everything.
How do you think, blockchain and crypto impacts the way you think about it?
I think everyone has like some sort of like, so like, how'd you get into Bitcoin? It's like asking someone if they smoke. It's like, it's like, yo.
Embracing where the world is going. And when the whole world shut down, we saw just how important tech was.
It was more so of my style and the foods that I cooked that kind of pushed me. I wanted to live the lifestyle of an athlete or an artist while doing what I love.
Having that open mind, having that flexibility just allows you to be of so much more service to, youth or society in general.
Gamers, maybe it's because you guys just hustle different.
Anything you want to be great at, you got to put hours and hours in every single day.
That looks like a really fun podcast. I want to be a part of here with The Hash. Hey, everybody. We're back. Sorry.
My story just knocked down a peg.
Sorry, guys. I didn't mean to do that.
Rip, George.
I'm basically a rookie here.
No, you're right.
So my story is about an article written about our friends at JPMorgan about a research report that I haven't had a chance to read yet. But the gist of it is this. According to our esteemed newsroom at CoinDesk, Ethereum is on the cusp of losing its battle with Solana, which is 2021's smart contract crypto darling, because Ethereum is ceding NFT market share volume to Solana. I talked about earlier. I will caution, I'm hardly a fan of non-Bitcoin digital assets and cryptocurrency, but I think I'm coming to the defense of the altcoins right now. So someone better be recording this, which I think we are. JPM cautions, and I quote, if Ethereum's loss of NFT market share continues in 2022, it could be a bigger problem for its valuation because, and I quote once again, Ethereum's share of the NFT market is likely to be more important than its share of decentralized finance or DeFi. Again, not an Ethereum maximalist, not even really a fan, not even a proponent, but JPM killed me with this one. First of all, Ethereum still dominates NFTs. We have this OpenSea chart to the right that just shows a crazy amount of volume going through Ethereum NFTs. And I mean, OpenSea was valued at $20 billion. I couldn't name 2 Solana NFT projects. I could probably name 10 or 15 Ethereum ones, and I don't own a single NFT. The volumes are so crazy. But I think this kind of makes sense from JPM. They're rightfully scared of a quote-unquote new financial system. So, of course, things like DeFi and Ethereum and things like Bitcoin scare them. And it scares them enough to use their brand name and their power to say it just doesn't matter. It's inconsequential. So I'll go on record and say that NFTs are not Ethereum's killer app. It's also not Solana's killer app. The killer app is something that JPM seems afraid of for some reason. And although I think DeFi is better on Bitcoin or Bitcoin itself is DeFi versus the alternatives, it doesn't mean I'm right, and it doesn't mean JPM is right. And actually, I would say it definitely doesn't mean that JPM is right. I want to get Will's view on this because I think he's someone who really likes Bitcoin but also appreciates other things.
Yeah, God give me the confidence of a JPMorgan analyst who's been reading about Ethereum for 1 year, because this is just a bad take written into a report and shipped off to other analysts around the space. Like, look at the numbers, first of all. What you're saying there, totally correct. Solana, cool. Like, you've had a great year. You busted through some hoops that no one thought you were going to be able to do. At the end of the day, Ethereum is still where everything is going. It's the Manhattan to your New York blockchain. That's not going to change for quite a while. Look at fees, still very elevated on Ethereum. Fees are high because people are using it. That's just how it works. Look at the top projects, like you said, OpenSea, that's on Ethereum. It's almost a household name now. They're looking at maybe doing an IPO or possibly a token airdrop, probably not, but at least an IPO or something like that in the next year. And then, like you said, George, all the top projects, they're on Ethereum, but not on Solana. There's a few cool Solana ones, like we can say that. But again, this is like way overloaded statements here in this report. And it's pretty typical for these reports. Just going back over the last few years, these big banks put out these reports, they put out these notes to their audience, who is often other buyers and investors who aren't in the know as much. And then you can easily just pick them off. JPMorgan probably operating a nice little trading desk, reaping in some cash from this report they're handing out to investors. I want to throw this up to Zach, though. What was your take when you saw this headline?
Yeah, definitely a lot of cart before the horse vibe. Yeah, that's how you say that one. Yeah, definitely putting the cart before the horse on this one, folks. Yeah, Ethereum is still very much the main venue for all these things, and I think the expense proposition of some of these projects is a bit of conspicuous consumption on some of these things. Like you want to be in the prime real estate, and people are willing to pay the premium to be in the prime real estate. It's interesting to think about. I don't know how these networks will emerge and whether or not like one network will become the DeFi network, another one will become the NFT network. I don't know. I mean, I think we're talking about, the proof of stake merge happening on Ethereum potentially later this year, which could be a real game changer. Solana, obviously faster, cheaper because it is proof of stake as opposed to the currently proof of work Ethereum blockchain. Interesting to see how that's going to change the calculus and whether or not, things materially change once the consensus mechanism alters the dynamics on the Ethereum blockchain. This is something that Christy and Will have both looked into pretty deeply. So I'm going to toss it to Christy first, and then Will for their takes on that and whether
we got to
fact check. Do it.
Yeah, you fact check me all the time. It's time to get you right back.
I'm ready.
Solana is a proof of history chain. A proof of history chain.
Dang it!
Which
it's
similar, but mechanism marginalia. Okay.
I couldn't tell you what proof of history is that well because it's been a while.
Proof of space and time.
Yeah, always going to take a slam where I can get it. I'll give it to Christy now, though. I'll back off.
Well, yeah, proof of history, but also, it self-describes also as a proof of stake with proof of history. So I'm not sure how that all goes in. It works, I guess, together. But I think one of the interesting things, and that Zach has already sort of touched on, is the fact that JPMorgan is freezing the technology in time and assuming that what is happening now is going to happen forever, and ignores the idea, or at least it's more than an idea. Let's say that Ethereum is going to transition to proof of stake this year. It does have scaling proposals coming through the works that will be enabled at some point in time. Ethereum moves slowly. Only Bitcoin moves slower, I think, than Ethereum. But it will have it will advance on a technological level that will address many of the concerns that JPMorgan is talking about, and it choosing to ignore apparently from the surface. I'm not sure if the report gets into it a little bit more, but yeah, it's Solana right now, I think, is getting some market share because of factors that people are taking advantage of right now, which is the fast throughput, the lower fees, and the proof of stake versus proof of work narrative that's out there. And people are, people who are concerned about the energy consumption of proof of stake blockchains are looking for those, proof of work blockchains are looking for the proof of stake ones, and they're going to Solana because it seems to be working out fine. But that is not going to be the case forever. George, I saw your hand go up.
Yeah, I love dunking on banks. It's like my favorite thing to do in the world. So I'll add something here that's somewhat related to this. Is I think it was Bank of America that was saying that Avalanche was going to be the future of smart contract cryptocurrencies.
Yeah.
I think it was Bank of America. It's just interesting to see the banks kind of move on from. Yeah, exactly. Yeah, it's funny. It's like pick your your fighter, SBF or like Suzu. I don't know who I'd choose there. SBF. It's funny seeing them move on from Bitcoin and kind of like, destroying Bitcoin and saying it's stupid and moving on to Ethereum now. Like, okay, we can't kill Bitcoin. Is it time to try to kill Ethereum? They're like, well, Solana is cheaper and Avalanche is cheaper and we can do more stuff. Like, when does this end? I mean, are they ever going to say, okay, fine, Onyx is stupid. We're not going to do anything in this anymore. We're just going to give way to the public blockchains. Well, latch onto that. Yeah.
Last thought I will say about this is Bitcoin has kind of put itself in a nice position because it's really the only thing they can kind of say it's money. All these other chains are competing for that number 2 spot, which is that smart contract platform. And it is a slippery slope depending on how fast you can upgrade your tech stack while staying online. And we've seen Solana has tried to do that, had some like network interruptions. I've seen Avalanche kind of pop up and then it died down for whatever reason. Now we have Near Protocol. We had Luna just a little bit ago. It's really just a circus. Everyone's treading water as quickly as possible, trying to stay above the line. And we'll see what happens into the future, but it's notable that Bitcoin has really cemented its place as like the money in the digital asset space. Going to give it to, I think Christy's got our last story, right?
I do. No, I got
Do it.
I got you. Yeah. So I brought to the table a really cool and thought-provoking opinion piece by CoinDesk's own Daniel Kuhn, where he looks at the question of, is crypto a Ponzi? And comes to the conclusion that you need to define Ponzi in order to make that decision. And what's interesting about this piece is that it doesn't just define Ponzi, it attempts to redefine Ponzi. So I am going to peel back a couple of layers on this one. Last month, Robert McCauley, who is an economist at Boston University, wrote an op-ed, and he called Bitcoin worse than a Madoff-style Ponzi scheme. So his point was that people buy Bitcoin with the expectation of profit, and that eventually you're going to cash out to someone else, probably your greater fool. And he called it, he basically called it worse than your everyday pump and dump penny stock. Yeah, okay, so there's that. On the other side, you have Jake Chervinsky, who is the new head of policy at the Blockchain Association, and he is wary of people who are calling all crypto Ponzi schemes. Because as he points out, you're using the term Ponzi to mean an economic game with built-in investing incentives and high risk of implosion. The thing is that when you use the word Ponzi, what you're actually describing is a fraudulent scheme in which a criminal deceives victims to steal their money and leaves them with nothing and runs away with the profits, and it all collapses. And that is not what is happening in most cryptocurrencies. It's certainly not what's happening in Bitcoin. Now, as Daniel Kuhn points out, and he's totally right here, words evolve, terms evolve, language is fluid. And as somebody who has, studied linguistics, I appreciate that. On the other hand, as somebody who's studied linguistics and an editor, I also am very fond of, definitions that are widely agreed upon at any given point in time. And so far, I think that the idea of fraud and intent and there being a fraudster who is trying to trick people out of their money is still a key part of the Ponzi definition. So what Daniel does go on to do, though, is he talks about the idea of using sort of Ponzi adjacent terms like Ponzinomics or Ponzi-esque or Ponzi-ish in order to describe crypto schemes that have the promise of high returns if everybody buys in and if everything works out, but really there is that sort of bag holding potential at the end of the day. As he points out, it's why people ape into various protocols. And to a certain extent, it might even be part of the mindset behind hodling Bitcoin. So I'd love to hear what you guys have to say about this, because are you on the existing definition side, the fluid language we need to redefine Ponzi side of things? And is this bad branding for crypto? Zach, I want you to start with this.
I saw Will's hand go up, so I'm going to defer to him.
Oh, you want to go to Will?
No,
okay, sure.
Real quick, I love what you said earlier, that from my reading of what you're saying, at least, you said crypto can't be a Ponzi because at the end of the day, you do get something, which is true. You can still get a token, which is pretty nice. The question is that token going to have some value once the cycle kind of goes down 95% and you're stuck holding a bag of coins that will never, ever pump again? And a case for a lot of these NFT bros out there who are getting wrecked left and right. At least they have a picture, I suppose. Oh, yeah. Zach, I'll give it to you, though. That's kind of the only insights I have. It was a really great piece by Daniel, I will say.
Really good piece.
Yeah, the theory of the greater fool is definitely different than Ponzi. Ponzi is like there's a central actor. He's taking money from new investors. He's giving that money to old investors. Ponzi requires a central intermediary. There's no CEO of Bitcoin who is taking the money from Coinbase and giving it to the older investors. It just doesn't work that way. However, there are many, many, many greater fools in the crypto markets, whether that's a VC selling the coins that they bought at a particularly low price, talking those bags up, selling them at a higher price, and then watching that precipitous fall, whether that's someone who is swept up in the heat of the moment, the emotion, the FOMO, the fear of missing out on the latest hot NFT mint that for one moment seems like the hottest thing since sliced bread. And then for every subsequent moment is just an absolute dud of an investment. So there's plenty of greater fools in this market, and it's a particularly transparent, dynamic market in which you can observe all this stuff happening. There's tons of data. There's tons of public information about what's going on in this market. This market is absolutely full of greater fools. Is it a Ponzi scheme? No, definitionally, it's not a Ponzi scheme. Is there scams, fraudsters, slimy people, morally dubious actions occurring around a lot of these tokens? Yes. Is it a Ponzi? No. So the question is, get the terminology right is what I'm thinking.
Yeah. And the problem is when you call everything a Ponzi, you're not actually labeling the actual Ponzi. And there are Ponzi schemes. In fact, as Will points out, there's one project out there called Ponzi. I think it's Ponzi.io. And they're like, we're a Ponzi scheme. Why don't you be one of the early people who doesn't get caught with the bag? Get in now, and then you can sell it. And they're like very upfront. George?
Yeah. And this is something I'm actually openly guilty of. And Christy, as my editor, and as someone who, I use the term open Ponzi's quite often, actually. And I didn't study linguistics. I studied math. Christy's my editor, so she's probably going to laugh at this answer. But I think that you can say words that mean something, but if you put more words around it, you can kind of qualify what you're actually trying to say, which is my really long-winded way of saying we can call them Ponzis if we want to, as long as we qualify it. I can talk about this all day, actually, but I think some of the critiques that were brought up in the article that you mentioned, Christy, are hilarious. Robert McCauley, his critique was referencing Bitcoin is a zero coupon perpetual, which is hilarious because zero coupon bonds actually exist. So he's pointing to something in the financial system saying, oh, this is clearly a Ponzi because of the zero coupon thing, but like those things exist. So it's kind of funny. But I also somehow disagreed with Stravinsky's point where he said this is doing massive damage. I don't think so. I think people know that this is a risky environment. The one thing I'd say is that the reason we're using Ponzi-nomics, or I use Open Ponzi, is that calling it long-dated pump and dumps without a clear central figure just doesn't roll off the tongue very well. Anyway, that's my 5 or 10 cents.
Fair enough.
It is catchy. Shout out to Charles Ponzi for having a great name and getting busted for doing some shenanigans. All right. That's the show today. Thanks for watching The Hash on a Wednesday. I'm Zach Seward. We got Will Foxley, George Clutis, and Christy Parkin. We'll be back tomorrow. Hey, also, remember that promo of that really cool show, not a podcast, show.
It's a video podcast.
New Money. It's a video podcast /show/showcast. It's a showcast. It's on today, 1 p.m. Eastern, right here on CoinDesk TV. If you haven't checked it out, it's with Spencer Dinwiddie and Solo Cisse. It's called New Money. It looks really cool. You should go watch it. It's on at 1. That's in like 28 minutes. All right. We're going to wrap it there. Thanks for watching us. Go watch that. Read CoinDesk in the interim. That's a winning formula right there. We'll talk to you tomorrow. Have a great one. All right. Bye.
See ya.